There's a $37 trillion time bomb ticking in the heart of the American financial system. And in 2026, it is going to detonate. Most people, including the ones currently managing your 401k, are calling what's coming a recession. They use soft, comforting terms like correction, slowdown, or the elusive soft landing. But that is a lie. What we are facing isn't the slow burn of a typical economic cycle. It is a controlled demolition, a detonation that will wipe out decades of accumulated wealth in a matter of weeks. Every domino is already in position. Every fuse has been lit. And right now, as you are watching this, the mechanism is already in motion. This isn't a weather forecast, and it isn't tea leaf reading on CNBC. This is cold, ruthless mathematics. Look at the numbers. The numbers don't lie. Over $500 billion in corporate debt is currently racing toward a concrete wall, the refinancing deadline. Companies that borrowed billions at 3% interest rates during the era of free money are about to face the reality of 9% rates. Banks that seemed like rock-solid fortresses are sitting on portfolios of commercial real estate that are worth half of what they were 2 years ago. And the very institutions that were supposed to catch the falling pieces, private credit funds and leveraged loan markets, are quietly pulling back into the shadows just when the system needs liquidity the most. Every expert who saw 2008 coming, every economist who predicted the dot-com crash, every analyst who called the housing bubble while everyone else was buying their third rental property, they are all saying the same thing. 2026 is the year everything breaks. But there is one terrifying difference, one factor that makes this crisis unique in American history. This time, the cavalry isn't coming. The government cannot save us. The Federal Reserve's ammunition is spent. The Treasury's balance sheet is maxed out. And the very foundation of American economic power, the bond market that has backstopped every crisis since World War II, is about to crack under the weight of unsustainable debt. Let me show you the anatomy of this catastrophe, stage by stage, month by month, institution by institution. Because once you see the pattern, you will realize we aren't approaching a financial crisis. We are already inside one. Most people just haven't noticed the ground moving beneath their feet yet. The first domino is already wobbling. It has a technical name, the maturity wall, and it is barreling toward American credit markets like a freight train with no brakes. To understand the scale of the disaster, you have to go back to the recent past. Remember 2020, 2021, and early 2022? The world was in the grip of a pandemic, yet financial markets were in a state of euphoria. Why? Because money was free. Interest rates were effectively zero. The Fed was pouring gasoline on the fire in the form of liquidity. Corporate America went on the biggest borrowing binge in the history of capitalism. They issued bonds. They took out leveraged loans. They loaded their balance sheets with debt because servicing that debt cost pennies. The average high-yield bond, junk debt, carried a coupon of around 5%. It was a gift. Corporate America gorged itself on cheap credit. But debt has one nasty feature. It doesn't last forever. Bonds mature. Loans come due. And this is where the math takes over. In 2026, over $500 billion of this debt hits maturity. This is debt taken out during the zero-interest era. Now imagine the CFO of a major corporation. In 2021, he borrowed $1 billion at 4%. His entire business model, his margins, his stock buybacks, his bonuses, they were all built on that number. In 2026, he walks into the bank to roll that debt over. And the bank tells him, sure, we can refinance you, but the rate is now 9%, maybe 10%, maybe 12%. That isn't just an increase in expenses. That is a change in the laws of physics for that business. A company that was profitable at 5% becomes insolvent at 10%. All the profit goes to interest payments. No money for growth, no money for payroll. You might think, well, these are big companies. They'll figure it out. They'll cut costs, lay off a few thousand people, issue equity. The strong ones will survive. The ones with fortress balance sheets and monopolies, Apple, Microsoft, Berkshire Hathaway, they'll weather the storm with wet ankles. But we are talking about the marginal companies, the so-called zombie companies. Zombie company sounds like something from a B-movie, but it is a strict economic term. It refers to a firm whose operating profit isn't even enough to cover the interest on its debts. They are only alive because they can borrow new money to pay off old money. They exist in a state of permanent financial coma. In the era of cheap money, their population exploded. By some estimates, nearly 20% of publicly traded U.S. companies fall into this category. They use cheap debt to paper over cracks in their foundation. They bought back their own stock to artificially pump the price instead of investing in production. In 2026, Judgment Day arrives for the zombies. When the refinancing costs double, these companies won't just struggle. They will instantly become insolvent. The math doesn't work. And when they fall, they will drag their lenders down with them. This is a classic chain reaction. The default of one major corporation is a problem for shareholders. The default of hundreds of mid-sized corporations simultaneously is a problem for the banking system. And this brings the second domino into play, the one they don't talk about on the morning news. We are used to thinking of lenders as the old traditional banks with marble columns and FDIC insurance. But over the last 15 years, the financial landscape has mutated. While everyone was busy regulating traditional banks after 2008, a monster grew in the shadows. The shadow banking system. Private credit funds, CLOs, leveraged loan vehicles. These institutions stepped into the void left by regulated banks. Today, they control assets worth over $250 trillion globally. Half of the world's financial assets are in the hands of organizations that do not have access to the Fed's emergency window. Understand the critical difference. When a traditional bank gets into trouble, regulators can step in. Shadow banks have none of that. It's the Wild West. When a private credit fund faces a crisis, it just dies, and it takes its investors to the grave with it. For the last 5 years, private credit was the buyer of last resort for risky corporate debt. But now, as 2026 approaches, these funds are facing a liquidity crisis of their own. Investors are getting nervous. They are demanding their money back. The flow of easy money that fed the system is reversing. Fund managers are hoarding cash, avoiding new deals, preparing for winter. Do the math. On one side, hundreds of companies desperate to refinance $500 billion. On the other side, shadow bankers turning off the taps. Demand for money is massive. Supply is vanishing. This is a classic liquidity crunch. In credit markets, this doesn't just mean prices go up. It means markets break. Companies that thought they could borrow at 8% suddenly find there is no money at 12% or even 15%. Financing simply ceases to exist. Doors slam shut. The music stops. And exactly at that moment, the third domino falls. The sound of the crash is being muffled by accounting tricks, but not for long. Commercial real estate. This sector has been quietly bleeding out for 2 years. But most of you haven't noticed because banks and landlords are playing a game that Wall Street cynically calls extend and pretend. They extend the terms of bad loans and pretend the collateral is still worth something. But you cannot hide reality forever. Office buildings across America are sitting 40%, in some cities 50%, vacant. This isn't a temporary pandemic hangover. It is a permanent structural shift. Remote work killed the demand for square footage. Here's the problem. These skyscrapers were financed on the assumption of 95% occupancy. At 50%, these buildings aren't just unprofitable, they are toxic. In the next 18 months, hundreds of billions of dollars in commercial real estate loans mature. Landlords will go to the bank to refinance, and the bank will see that the building, once worth $500 million, is now worth $250 million. But the loan is for $400 million. The math is ruthless. It makes more sense for the landlord to simply toss the keys across the banker's desk and walk away. Take it, it's your problem now. And just like that, assets turn into liabilities. Banks will end up holding thousands of properties they cannot sell without taking massive losses. And that leads us to the fourth domino, the institutions holding these toxic assets. Who holds this debt? Not the Wall Street giants. They were too smart for that. This debt is held by regional banks, the boring institutions where small businesses and average American families keep their money. Some of these banks have 30, 40, sometimes 50% of their loan portfolio tied up in commercial real estate. When landlords start defaulting en masse, the capital of these banks will be incinerated. We already saw the trailer for this movie in 2023 with Silicon Valley Bank and First Republic. We were told those were isolated incidents. That was a lie. Those were the first symptoms of a systemic disease. But the wave of 2026 will be worse, because this time banks won't be losing money on government bonds, but on completely illiquid real estate. And when depositors realize their bank is sitting on a mountain of worthless concrete, the run begins. In the age of digital banking, a bank run doesn't happen in lines on the street. It happens in smartphone apps. Billions of dollars vanish in seconds. Hundreds of regional banks will become insolvent. The FDIC does not have enough money to save everyone. To prevent total social collapse, the government will have to intervene. They will have to guarantee all deposits and print money. But this time, the rescuer has a terrifying problem of its own. We have arrived at the fifth domino, the foundation upon which the entire Western world rests, the U.S. sovereign bond market. Right now, the United States owes $37 trillion, but the scary part isn't the total amount. It's the cost of servicing it. Annual interest payments on the debt are approaching $1.2 trillion. That is more than the entire U.S. defense budget. And these payments are growing every month because old debt, borrowed at 1% or 2%, is maturing and being replaced by new debt at 4% or 5%. For decades, this didn't matter because the world always wanted to buy U.S. debt. It was the risk-free rate. But that assumption is about to be tested when the credit crisis of 2026 hits, when corporations fail, when regional banks collapse. The government will need trillions of dollars to bail out the system. Where will they get it? They have no savings. They will have to borrow it. But investors, China, Japan, Saudi Arabia, are looking at this chaos and saying, no, the risk is too high. They will demand higher rates because they understand one thing: the dollar is going to be debased. The Congressional Budget Office has already warned, if rates stay high, we enter a debt spiral. This is a situation where the government borrows money just to pay the interest on previous money it borrowed. That is the mathematical definition of bankruptcy. The corporate refinancing wall meets the sovereign refinancing wall. And that brings us to the ultimate question. Who will buy this debt if private investors refuse? There is only one buyer left: the Federal Reserve. But while everyone is watching the banks and the Fed, one more domino is falling in total silence. And it might be the deadliest one: the insurance industry. Remember AIG in 2008? Today, AIG is the rule, not the exception. For the last decade, insurance companies and pension funds suffered from low interest rates. They needed yield, so they went out into the risk zone, buying commercial mortgages and exotic derivatives. But now that rates are up and asset quality is crashing, their business model is broken. If an insurance company's portfolio loses 20% of its value, that is a solvency crisis. They have liabilities, your policies, your pensions, that must be paid. But the assets backing them are turning to dust, and there is no insurance for the insurance companies. When the giants fall, the only option is a government bailout, but the government is broke. And this brings us to the finale: the Federal Reserve's checkmate. Since 2008, the Fed has had one answer to every problem: print money. They became the shock absorber for the entire economy. But that strategy has a cost. It only works as long as people believe the money has value. In 2026, when the system screams for help, the Fed will face two paths. Both lead to hell. Path 1, save the system. Turn on the printers. Result, hyperinflation that burns the savings of the middle class to the ground. Path 2, protect the dollar. Refuse to print. Result, a total deflationary collapse. The Great Depression 2.0. History teaches us that politicians always choose inflation. They will choose the printing press. They will try to put out the fire with gasoline. And at that exact moment, America loses its greatest asset. The US dollar is not just a currency, it is America's superpower. Global trade is rigged in dollars, but the world is watching. China, Russia, the BRICS nations, they have been preparing for this moment for years, hoarding gold and building alternative systems. They know that in 2026, America will be weaker than ever. When the Fed starts printing trillions to save its bankrupt bankers, the rest of the world will say, enough. No one will want to trade real resources, oil, commodities, labor, for paper confetti printed out of thin air. Demand for the dollar will collapse, and all those trillions of dollars that have circulated abroad for decades will flood back into the US. That will be the end of American economic hegemony. The standard of living Americans have grown accustomed to, subsidized by the status of the reserve currency, will evaporate. This is not speculation. This is not a conspiracy theory. This is the logical conclusion of mathematical trends that are already written in ink. The debt is real. The maturity dates are real. The asset rot is real. The institutional fragility is real. The only question is the exact date. The dominoes have already started falling. You just don't hear the crash yet because the band on the Titanic is playing too loud. 2026 is the year of the reckoning. The year the system resets. The numbers don't lie. The mechanism is engaged. The outcome is inevitable. The only question is, will you be ready when the music stops?